Over the past year, something extraordinary has unfolded in the technology world. The entire tech industry is pouring money into AI at a scale the market has never seen before. Not billions, but hundreds of billions of dollars every year, accelerating quarter after quarter as if everyone is racing against time. Two of the most powerful companies at the center of this AI transformation, Alphabet and Microsoft, have already announced investment plans that redefine what large-scale spending means in technology. Both are now deploying tens of billions of dollars every quarter into data centers, compute clusters, power infrastructure, and proprietary AI systems. Their full-year capital expenditures are rising toward the $80 to $90 billion range, making this one of the largest corporate investment cycles in history. Combined, these two companies alone are injecting close to $200 billion a year into AI, more than what the US government has spent on education, training, employment, and social services in the 2025 fiscal year. The numbers are so large that even seasoned investors are starting to feel uneasy. For the first time in more than a decade, people are asking, is this still investment? Or is this becoming an arms race with no guaranteed return? The market has begun to wonder whether Alphabet and Microsoft may already be near their earnings peak, facing years of heavy depreciation from AI capex, while the eventual returns remain uncertain. Peter Thiel, one of the earliest backers of modern tech, recently sounded the alarm. He warned that parts of the AI boom are beginning to resemble the late 1990s, a period when capital flooded into technology faster than profits could be realized. After dumping his entire NVIDIA stake, his message was subtle but clear. If AI monetization does not catch up, these investments could become a liability. Yet at the very moment when the market turned cautious, a different giant moved. Berkshire Hathaway bought Alphabet. This single decision reveals a deeper contradiction. If earnings had truly peaked, if this AI spending cycle was merely burning cash, then Berkshire, of all institutions, would never have touched Alphabet. And so we are left with a very important question, one that every investor in Microsoft and Alphabet must eventually answer. Are we witnessing the end of their golden profitability era, or the beginning of a new growth trajectory the market has not yet understood? Hi, I'm Freeman. I'm an independent investor focusing on US tech stocks, as well as companies listed in Hong Kong and Singapore. Alphabet and Microsoft have been two of my core US technology holdings for many years. I've always viewed them as long-term compounders, the kind of companies you could hold indefinitely as long as their competitiveness and earnings growth remained intact. My approach was simple: hold through the cycles, and only consider selling when valuations clearly detach from fundamentals during market euphoria. But this time, something feels different. The sheer scale of their AI investment suggests we may be entering an entirely new phase. The risks have gone up, and the return timeline is far less certain. We're no longer looking at the steady, predictable compounding of the past. We are looking at a massive, high-stakes transformation that could reshape their entire earnings profile. And that puts me in a difficult position. As a long-term investor, should I continue holding Alphabet and Microsoft, stay patient, and let this AI cycle play out? Or should I start trimming my positions in anticipation of earnings compression caused by years of elevated capex? It's not a simple decision. It's a real trade-off between protecting past gains and positioning for future potential. That is why today I want to take a deeper look at the scale of their AI investment, the returns they might generate, and whether this level of spending is truly rational. Not to predict share prices, but to answer something more fundamental. Is the long-term return potential large enough to justify an investment of this scale and risk? Yes. The massive capex will create heavy accounting depreciation in the years ahead. But could this very same investment lay the foundation for a new, stronger earnings trajectory, one powered by next-generation AI infrastructure? And as usual, let me emphasize that this video represents my personal views and are meant for informational and educational purposes only. None of the discussion here should be considered financial advice or a recommendation to buy or sell any security. Please do your own research or consult a qualified financial advisor before making investment decisions. To judge whether Alphabet's and Microsoft's massive AI investments are rational, we need to look beyond the headline numbers and examine three things: why they are spending this much, how long they plan to spend at this pace, and what they ultimately expect this infrastructure to deliver. The current scale is already huge. Alphabet recently raised its 2025 capex guidance to $91 to $93 billion, while Microsoft expects to spend around $80 billion. But these figures are not random or reactionary. They reflect the nature of what both companies are trying to build. They are not simply refreshing hardware. They are constructing a new generation of gigantic compute infrastructure. This includes building entire data center regions from scratch, upgrading electrical grids and power plants, deploying advanced cooling technologies, and ultra-high-speed networking systems required to support AI at global scale. Their platforms must handle the full life cycle of AI, training frontier models, serving real-time inference to billions of devices, and powering AI-native enterprise workflows across the world. In this new landscape, the biggest bottleneck is no longer software innovation. It is compute capacity. The company with the largest, most reliable, and most widely distributed compute footprint will set the pace for the next decade of AI leadership, and the company which lagged behind AI capabilities is set for eventual demise. In short, the risk of underinvesting in AI far outweighs that of overinvesting. This ambition also explains the timeline. These are not one-off purchases. They represent the beginning of a multi-year, multi-layer infrastructure build-out for the AI era. What used to be a steady capex rhythm tied to cloud demand has evolved into a continuous expansion across the entire technology stack. Both companies have already signaled that 2025 to 2026 will be the peak years of AI spending. But spending will not collapse after that. Instead, it will settle into a sustained, elevated plateau. Alphabet expects exceptionally high annual capex post-2026, spending $75 to $95 billion per year from 2027 to 2028. Microsoft has outlined a similar pattern, projecting $55 to $70 billion per year over the same period. In short, elevated AI investment is not a temporary surge. It is a long-term strategic commitment, one of the biggest infrastructure expansions in corporate history. To properly assess whether Alphabet's and Microsoft's AI investment strategies make sense, it helps to translate their multi-year capex plans into a single, comparable figure, the present value, or PV, of all future spending. This allows us to see the true economic scale of their commitment, adjusted for time. In the case of Alphabet, its annual capex sat comfortably in the $20 to $25 billion range from 2019 to 2021, mostly supporting traditional cloud expansion. But once the AI era began, the numbers shifted sharply. Capex rose to more than $30 billion in 2022 and 2023 as the first wave of AI infrastructure rolled out. Then the acceleration became dramatic. Spending jumped to $52 billion in 2024 and is projected to surge past $90 billion in 2025, marking the start of Alphabet's full AI supercycle. The company expects capex to remain extremely elevated through 2026 to 2028, US $95 billion in 2026, $87.5 billion in 2027, and $82.5 billion in 2028. What happens after 2028 is less clear, but once the major build-out is complete, it is reasonable to assume spending will shift from rapid expansion to steady maintenance and refresh cycles. Using conservative assumptions, post-2028 capex stabilizing at $45 per year, roughly half of the peak amount, with long-term growth of 3%, and a 10% discount rate, the present value of Alphabet's AI investment cycle, 2022 through perpetuity, comes to $933 billion. This single number condenses years of accelerated, large-scale investment into a unified measure of Alphabet's long-term commitment to AI infrastructure. Let's look at Microsoft. Microsoft followed a very similar trajectory. In the pre-AI years of 2019 to 2021, its annual capex was substantial but stable at around $20 billion, mostly supporting Azure's continued cloud expansion. But once the AI wave began, spending accelerated quickly, rising from $30 billion in 2022 to more than $40 billion in 2024. The real inflection point arrives in 2025. Capex is projected to double to $80 billion, and Microsoft expects spending to stay at a very elevated level through 2028. US $75 billion in 2026, $65 billion in 2027, and US $60 billion in 2028. As with Alphabet, it is reasonable to assume that once the major AI build-out is complete, Microsoft's annual spending will shift from rapid expansion toward a steadier, sustainable maintenance cycle. Using conservative assumptions, post-2028 capex stabilizing at $40 billion per year, again, half of the peak amount, with a long-term growth rate of 3% and a 10% discount rate. The present value of Microsoft's total AI investment cycle comes to around $808 billion. This figure captures the full economic scale of Microsoft's long-term commitment to building the AI infrastructure of the future. When we translate Alphabet's and Microsoft's multi-year AI CAPEX plans into present values, the result is astonishing. Together, they are committing nearly $1.7 trillion in today's dollars to build the AI infrastructure of the future. For investors, this brings us to one central question. Can these companies earn back what they are investing? That is the question we must answer, because this isn't about one fiscal year's capex or a temporary spending surge. It is about a massive multi-decade capital base that their future profits must ultimately justify. And whether this investment pays off will define the next 10 to 20 years of growth for both companies and for their shareholders. To understand whether Alphabet and Microsoft are being reckless or rational with their massive AI spending, we must look at the other side of the equation, the future revenue that AI will generate. This is the heart of the matter. To test whether their capex makes economic sense, I built a long-term revenue model broken into 3 logical phases of AI adoption. Phase 1, 2025 to 2028. The early acceleration years. AI begins scaling across all major product lines, but the world is still adjusting and experimenting. Phase 2, 2029 to 2038, the true AI consumption cycle, widespread adoption, rapid penetration, and AI-driven productivity embedded into daily life and enterprise workflows. Phase 3, 2039 and beyond, the stabilization era. AI becomes fully normalized in society, and growth slows back toward long-term structural rates. These phases allow us to test one simple question. Are Alphabet and Microsoft building too much too early? Or are they investing just enough for the world that's coming? Let's start with Alphabet's revenue projection model. Its 5 major pillars: Search and Other, YouTube Ads, Google Network, Subscriptions and Devices, and Google Cloud. These are the core engines that AI will strengthen, transform, or replace with more advanced, intelligent versions of themselves. Predicting future revenue with precision is impossible. Even Alphabet cannot do that. But we can assign reasonable, grounded growth estimates based on how AI enhances each business line, industry forecasts, historical growth patterns, and the natural limits of market size. These are the growth assumptions I used for each business segment under the different growth phase. Search and Other. With AI, Google Search gets smarter and more interactive, driving new use cases and higher ad value. This can lift ad quality, user time, and commercial intent. However, Google Search is unlikely to grow 20 to 30% anymore. The base is too big. A modest uplift of 5% in the early years and 8% during the main AI supercycle reflects a sensible, sustainable pace of improvement. YouTube ads, short-form videos, AI-generated content, and highly personalized ad targeting will push YouTube into a new growth gear. Therefore, 10% in the early AI phase and 15% during the wider AI adoption cycle sit comfortably within industry expectations. Google Network. This segment is mature and heavily dependent on external publishers. AI may improve yield, but this is not a hypergrowth area. Thus, 3% in the early phase and 5% in the main adoption cycle are conservative but realistic assumptions. Subscriptions and devices. YouTube Premium, YouTube Music, Play Store, and Pixel hardware all benefit directly from AI personalization and creation tools. Given the large user base and growing demand for personalized content, 10% early phase growth and 15% during the supercycle are reasonable and well supported by subscription industry trends. Google Cloud. This is the most AI-sensitive division. Demand for training, inference, vector databases, and AI-augmented enterprise services is exploding. Major industry forecasts project hyperscaler AI workloads to grow at mid-teens, exceeding 20% for years. Thus, 20% growth in the early phase, transitioning to 15% over the 2029 to 2038 cycle, is not aggressive. It is conservative relative to expectations. So, is Alphabet's spending justified? Using these realistic but not overly aggressive growth assumptions and applying a 10% discount rate, the present value of Alphabet's future AI-driven revenue discounted back to 2025 comes out to $7.5 trillion. Now compare that with the present value of Alphabet's AI investment, US $933 billion. This means Alphabet's long-term revenue potential is roughly 8 times the scale of its AI investment. And that is the key insight. Even under conservative assumptions, the projected economic value created by AI across search, cloud, YouTube, subscriptions, and devices far exceeds the cost of the AI infrastructure being built today. In other words, Alphabet's investment is not blind spending. It is a calculated, long-term bet where the potential payoff is many times larger than the capital being deployed. Now let's apply the same framework to Microsoft. Microsoft operates across 3 powerful business engines, contributing to its total 2024 revenue of $245 billion. Intelligent cloud, productivity and business processes, and personal computing. These are the pillars on which AI will either drive better monetization, expand usage, or even create entirely new product categories. As with Alphabet, we analyze Microsoft's AI-driven growth across the 3 logical phases of the AI cycle. Here, we assign reasonable, conservative AI-driven growth expectations for each segment based on industry trends and the underlying economics of Microsoft's businesses. Intelligent cloud. Azure sits at the center of the global AI boom. Every large enterprise is modernizing infrastructure and shifting workloads to cloud AI systems. Training clusters, inference workloads, vector databases, and enterprise agents all live on the cloud. Major analysts project hyperscalers to grow at mid-teens for many years due to AI workloads. Microsoft is also gaining market share from AWS, boosted by its first-mover advantage via Copilot, Office integration, and its partnership with OpenAI. Thus, 20% growth in the early phase and 15% during the broader AI supercycle are not aggressive. They are consistent with industry expectations. Productivity and business processes. Office 365 has been a steady compounder for over a decade, but AI copilots fundamentally change the economics. Instead of selling software, Microsoft begins selling productivity gains, workflow automation, and intelligent AI agents. If copilots become standard in corporate software subscriptions, as Microsoft intends, this segment will see a meaningful uplift. A 10% early growth phase, followed by 8% through the 10-year AI cycle, is conservative and well justified. Personal computing. Windows and Surface are mature businesses, but the rise of AI PCs, NPU-powered laptops capable of running AI locally, introduces new upgrade cycles and user demand. On-device copilots and consumer AI tools create additional tailwinds. Growth won't be explosive, but a stable 5% across the next decade is realistic and supported by the shift toward AI-enabled personal devices. Applying these realistic growth rates and using a 10% discount rate, the present value of Microsoft's future revenue from 2025 onward comes out to $6.44 trillion. This is the entire future revenue stream, adjusted for time and discounted back to 2025. Now compare it to the present value of Microsoft's AI investment, which we calculated earlier, $808 billion. This means Microsoft's long-term revenue potential is about 8 times its AI investment PV, almost identical to Alphabet. Here are my conclusions from the analysis above. The fact that both Alphabet and Microsoft independently converge to roughly an 8 times return leverage tells us something very important. Their AI spending is not reckless, it's calculated. The numbers make sense when viewed through a long-term economic lens. Both companies expect AI to reshape their entire business models, not just enhance them. These investments are not meant to pay back in 2025 or 2026, but over decades. Above all, this is a moat-building phase, the kind that locks in dominance for the next 10 to 20 years. And no company deploys tens of billions a year unless 2 things are true. 1, the risk of not investing is existential. 2, the payoff, if successful, is disproportionately large. This is exactly what we see here. Yes, AI capex looks extreme if we stare only at next quarter's earnings. Depreciation will undoubtedly drag down reported profits in the short term. But this is just noise, a temporary accounting distortion, not economic reality. Once the AI infrastructure is built and monetization kicks in, Alphabet and Microsoft will not fall back to their old earnings trajectory. They will shift onto a new, steeper curve, one that rewards investors who remain patient through the heavy investment years. From a long-term perspective, their earnings are far from peaking. This is also why Berkshire Hathaway bought Alphabet while analysts were panicking about AI capex overspend. Buffett's team didn't misunderstand the situation. The market did. They saw what most people missed. AI spending is not a cost problem. It is the foundation of the next era of earnings growth. And of course, everything I've shared here reflects just my personal perspectives based on my own analysis. Nothing in this video should be taken as financial advice or a recommendation to buy or sell any security. Please always do your own research or consult a qualified financial advisor before making investment decisions. Thank you for watching. Goodbye and have a great day.